there are 7 simple commandments that you should follow to make reliable forecasts and prepare a meaningful budget. 1. The most likely estimate at a given time T shalt thou prepare. 2. Prior period financial data shalt thou employ. 3. The cost structure of thy business activity shalt thou analyze. 4. Thy understanding of the market and the economic environment shalt thou deepen. 5. Internal and external competencies shalt thou draw on. 6. On the essential shalt thou focus. 7. Thy expense items shalt thou never inflate. We will now analyze each of these principles together, as well as the pitfalls that you should avoid. The most likely estimate at a given time T shalt thou prepare. When my superior asks me for my sales budget for next year, I normally haven't got a clue. The economic context changes so quickly, and there are so many factors to take into account.
Indeed, some managers say that they are incapable of forecasting their revenues and costs. Budgets are normally inaccurate. In fact, budgets are often revised.
Ah, is that what we call a rolling or continuous budget?
Yes, the budget manager's objective isn't to make exact forecasts. Instead, by using realistic and justifiable assumptions, the budget manager should calculate the most likely estimate at a given time T in order to facilitate decision-making.
A forecast isn't necessarily correct. It's the most realistic estimate possible. If a variance arises, we will revise the budget. The significance of a figure is not its actual amount, but the impact that it will have on your management decisions. Prior period financial data shalt thou employ.
It is important to refer to prior financial data, if there is any available, of course. You can base your forecasts on prior year figures, on figures from the current month, and so on.
It would be surprising if calculating our budgeted staff costs were as simple as increasing each employee's salary by 3%.
Of course, using figures from year N-1 doesn't mean that we should just perform a simple extrapolation.
I've heard that some companies advocate zero-based budgeting, or ZBB, in order to force each budget manager to reflect on the structure of each cost center in function of anticipated needs, rather than simply applying a given framework.
All the same, the prior year figures provide a frame of reference, which is normally the starting point for preparing forecasts. Let's go back to the example of staff costs. We need to review changes in headcount and salary rises and to update Social Security contribution rates. We can start with prior year personnel costs. By integrating these factors, we can prepare our forecasts, avoiding omissions or discrepancies.
Remember that you can use all of your company's management tools to help you fine-tune your approach. Cost accounting, internal reports, and so on. The cost structure of thy business activity shalt thou analyze.
You will never be able to make relevant forecasts if you don't understand your cost structure. You need to break down your expenses, distinguishing between fixed and variable costs.
We saw this in the first part.
Exactly. You should end up with a breakdown of net income that is less accounting-focused and more management-focused and easier to use. However, to do this, you need to do some initial work to distinguish between fixed and variable costs.
Thy understanding of the market and the economic environment shalt thou deepen.
There are numerous factors to be taken into account. but we must always analyse the economic context of our business activity. A budget manager needs to deepen his or her understanding of the market and the economic environment. For example, increased volatility of raw materials prices, potential supply shortages, a new entrant on the same distribution channel, a fall in household expenditure indices, and so on. These constraints, or opportunities, affect our forecast figures. The purchasing department and the sales and marketing department can be good sources of information because their role is to perform detailed data monitoring and analysis.
Internal and external competencies shalt thou draw on.
As we have just seen, it is essential to tap into other competencies. There are two reasons for this. We can't be experts in every domain. To tackle complex or technical factors, never hesitate to directly contact the people most qualified to help with the issue.
So, to forecast my rejection rate, I will go directly to the quality manager. Relying on the skills of your colleagues has a second advantage. This approach engages the whole team and makes them responsible for their actions.